The IRS 1031 exchange, one of the best wealth building tools available to investors today. Hey guys, Brenton Haynes here. Thanks so much for tuning back in. And before we dive in it, be sure to hit that subscribe button, smash the like button. I would really appreciate it. So today we're going to talk about the infamous 1031 exchange, how it works, what the timeline is, and why investors love it. So what is the IRS 1031 exchange? Well, that helps us take our equity from one property to the next without paying taxes. We're kicking that can down the road. We're not going to pay taxes until we finally sell that property and completely cash out. And there's my rooster. So guys, so why do investors love the IRS 1031 exchange? Real simple. Taxes. We get to defer our taxes, not pay our taxes until we actually sell that property and cash out. So we can take our equity from one rental property into the next property. So there's some great advantages with 1031, and there's a lot of reasons why investors do it. It can be simply to reposition that equity. It could be, hey, I'm moving to a new town and I want to keep that rental property close to me. Lifestyle changes. There's a lot of opportunity here with the 1031 exchange. I typically use it myself to reposition my equity for more growth and get into larger properties, better cash flow. So what does it look like and how does it work? So the IRS is going to give us some guidelines and some rules to play with, and if we don't stay within that, we're going to end up paying capital gains tax. So if we step out of line just a little bit, it can put us in jeopardy of some huge liability depending on the size of property you're selling and how much equity you have. So let's take a look at some of these rules and the timeline. So let's start off with the rules. So we have 3 rules that we can use to identify our exchange property, or what's commonly known as our up-leg property. We have the 3 property rules, so we can identify up to 3 properties that's going to be of equal value of the one we're selling or more. We can't go below. If we go less, we're going to end up paying capital gains on that difference. The other one is going to be a 200% rule. We can identify as many properties as we want. It's going to equal up to 200% of the value of the property we're selling. And the last rule is going to be the 95% rule. We can identify as many properties as we want, but we got to close on 90% of that aggregate value of those properties combined. Now, in the 20 years that I've been doing 1031 exchanges, I've only ever used one rule. That's the 3 property rule. It's real simple, it's easy for people to comprehend, and they're typically under a lot of stress, and so they don't want to juggle the 200% rule or 95% rule. It gets kind of lost with them sometimes. We'll make it simple. Okay, so let's take a look at this timeline. So once we close on our downleg property, our existing rental property, we've marketed it, we found a buyer, and we've closed. We have 45 days to identify our property or properties that we're going to use as our up-leg. Now, once we've identified that up-leg property or that replacement property, we have up to 180 days since we closed our down-leg property to close on the up-leg property. It's as simple as that. Now, it doesn't seem too complicated, but when you're in a market like we are today, finding a property in 45 days really is not enough time. So there's a few little tricks, and the next video I'm going to show you is how to hack the 1031 exchange timeline and get more time out of it the right way. We'll see you guys in the next video.